292. That's all we need to know about. I'm going to explain exactly why. We're going to go through the details, but we're going to keep in mind why 292 is extremely important, and everything that this market is doing going forward will hinge on the number 292. Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, October 3, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And let me explain the 292. So we now have what we're calling the red line on the screen. It's 292. Why is that important? We're going to go through all the other markets, and there certainly are clues in the opposite direction, right? So there still remains divergences out here in the marketplace. However, we're going to try and narrow down what we're doing across any of the markets to something very simple, 292. Why is it important? Let me show you exactly why I think that number is important from the chart we're looking at, the daily chart of the SPY. And then we'll go from there and we'll go through the other markets. Before I get going, let me take a pause and just make mention that I appreciate everybody's participation in posting comments under the video. Please continue to post your thoughts. It's helpful to the entire community. I appreciate everybody's participation and efforts. In addition, please hit the like button on the video and share the video with anyone you think can benefit from this information. Why is 292 important? All right, so we have this red line, and if it gets in the way, I'll take it off. But I think everybody's going to get the point rather quickly. Let's start all the way back here on the 30th of August. Is it the 30th? The 29th of August. So the market rallies up. Not necessarily is 292 important. I don't want anybody to have a misunderstanding that if the market closes at 291.99 versus 292.01, there's an enormous difference. That's not what I'm saying. Let's make sure we're clear on something. We don't have to get to the penny when we're talking about the Spider, because whether it's 292 or 291.75 or 291.62 or 292.38, it's in this range that becomes important. Let me clear it up and I'll explain what I'm referring to. So we go back to the 29th and you see here that the market made a high of 291.74. So we know that that number or something in the vicinity within pennies of that number is important to the market. Otherwise, the Spider or the SPY on the way up or the S&P 500 would not have been rejected otherwise at that price. Now the market comes back up and it begins to make an attempt to get through that price level. Here making a high of 291.58, making a high here of 291.69. And here's something that we talk about quite a bit, and I think it's worth mentioning right here, which is when the market's having a difficult time getting past a certain price level, whether it's on the upside or the downside. So if the market's having a difficult time getting through a resistance level, it will sometimes gap over that level. That's an easy way through a level. The same thing goes on the flip side. If the market is trading down and it's having trouble busting through a support area, it may gap down over that support area at the open one morning, and that's one way. An easy way to get through a support area is to gap beneath it. Let's keep going here. So what we have here is the close of the day is 291.99. This is on the 21st, and the low of the day is 291.81. So I would say based on those numbers, and so far everything else that we've pointed out, that somewhere in the vicinity of 292 happens to be important to the market. Now here, we made a high slightly lower, but it was 291.65. But yet again, making an attempt into that zone. Here, we get into the 292s. We make a high of 292.25 or 292.24 to be exact, and we're rejected. Moving the chart over, the next day on the 27th of September, making a high of 291.91. And I think everybody begins to get the point, and you can see what happened the last 3 days in a row. We seem to be trading around this 292 area. I think it's extremely important to the market. I think closing daily above 292 will be extremely important to the market. I think it'll bring more upside. I think continuing to close below 292 is bearish. We're going to call 292 our daily pivot. I understand other markets are doing other things, but in terms of the spiders, 292 is the daily pivot. If it begins closing daily above 292, I'm going to begin getting bullish. If it remains below 292 and cannot close daily above 292, I'm going to remain bearish, and that's the way it is. Here's a 60-minute or hourly chart of the SPY. There's a specific reason why, and I want to reiterate again something we talked about already this week, which is institutional distribution. We're seeing it again. You can see here that on an hourly chart, the market makes, or at least begins to make, a bullish consolidation pattern. Now, I'm looking at this all day long, and I'm thinking to myself that the market is consolidating to try and fill this gap up here. That's what it looks like to me. Made an attempt, wasn't able to do it. We're consolidating, building some energy to go up to fill that gap. That's what I suspect is going on earlier in the day. But here we are again for another afternoon session where the market just collapses down, and you can see it was almost like a carbon copy, but on a bigger scale than yesterday. And you can see here, each and every time the market goes up, it's met with sellers. That's institutional distribution. It's part of a topping process. Now, how can I say on one hand, part of a topping process, and on the other hand, telling you that above 292, I'm going to get bullish the market? It's a good question. I'm glad you asked. Let me answer it. It can be both. And let me explain. So in a topping process, a lot of weird stuff tends to happen. That's what we're seeing now. We're seeing a lot of weird activity across markets. We've been talking about divergences. We've been looking at various stocks. We're seeing distribution in the spiders. You can see it crystal clear on the hourly chart. And you can see each and every time the market gets above this 292 area, it dives back down. So I'm putting those things together and saying that's part and parcel to a topping process. It's not the total story. It's not the entire picture, but it's a couple of components important within the topping process. But at the same time, within a topping process, we can have what's called a super spike. We have to be aware that this exists. Now, I think the first hint that we could see a super spike is begin to close daily above 292 on the spiders. That's the area I think becomes extremely important if we close above. What does a super spike look like? A super spike looks like, and it's usually on the heels of some kind of event. It's some kind of news-related event. Where are we now? It could be an event relating to trade. It could be an event relating to tariff discussions with China. It could be Iran. It could be North Korea. It could be something that we have no idea about. It doesn't really matter what it is. If we get a spark and we begin to push higher in the market and you start to see hourly closes get above 292 and it begins to push higher, I think the move is likely on, and daily closes above 292 and certainly a couple of days in a row, we could see a super spike that could bring the market up to that 3,000 area. That's meaning the S&P 500 up to the 3,000 area. Right now, it's 2925. The S&P 500, or the SPY rather, is 291.50. We're talking about 300. So we're talking about another, let's just use round numbers and say ballpark numbers. I don't know that we could get to 3,000, but we'll say in the vicinity of 298 to 300 in the SPY, 2980 to 3,000 in the S&P 500. That's on a super spike. I'm not saying that's going to happen. I'm saying it's something we need to be aware of within the topping process. It's been known to happen. It's happened before. It can happen again. It will likely at some point happen again. Now, if that happens, we will likely see some kind of a gap and crap at the end of that process, or we will likely see some kind of high volume reversal take place in the market. But if we begin to push higher and we begin to close hourly and then daily above 292, I would be very cautious about being short the market. Now, when I go down to a 10-minute chart, I'm going to explain what's been happening the last few days to many traders out there. I've heard from some of you, and I know it's happening to a lot more. I understand. Here's a low, here's a high. Here's a low, here's a high. Here's a high, here's a low. What's happening to traders out there is they're getting fooled. They're getting tricked, trapped, fooled, and frustrated. They're getting sucked in on the way up, getting whipped out on the way down, or vice versa. Those of you that have been going through this over the last couple of days know what I'm talking about. It's not an easy environment to trade, specifically if I'm right and we are in a topping process. And when I say topping process, again, let's quantify what that means. I'm not necessarily suggesting it's an all-time high. It may be, it may not be. We don't have to decide that, and we certainly won't know that until later on. All I'm saying is that the market is acting as if it's in the midst of a topping process. I'm going to take it at face value. I have a number that I'm comfortable using as a daily pivot. It's 292. That's what I'm going with. It makes things simplified as far as I'm concerned. If we get a super spike up, I want to ride part of it up, and then I certainly will be looking for a reversal to happen, but I'm going to let the market levitate a little bit if this happens. They're going to suck in all the retail investors out there. That's the way it works. They suck in the individual investor. They hear the news. They think everything is great. They hear all the analysts raise their price targets on all the indices. They think there's another 1,000 or 2,000 or 3,000 points coming in the Dow. They rush in, they buy the market, and that's the way the institutions get the final push higher, allowing them to sell whatever they want to sell into that push higher. The market reverses, and then we go through a corrective phase. I'm not saying that's exactly what's going to happen, but I've read that book many times. Now, let's flip it over a little bit and talk about the IWM, my favorite market leading indicator. And what do we have here? We have an IWM that was up today. It was up about 0.8%, but it was up more earlier, a little bit of a fadeaway at the end of the day. Interestingly enough, the IWM did not act the same in the opposite direction as the spider. And herein lies, once again, and I understand some of you questioning, hey, I thought this was your favorite market leading indicator. Why is it acting opposite the market, meaning the S&P or the Dow? And it's a great question, and herein lies part and parcel to that weird activity within a topping process. It's a good question. Let me show you further what I'm talking about. So when you go down to a 10-minute chart and you look at the IWM, here's today's activity in the IWM. This is where we opened the day. This is the first 10-minute candle of the day, and everything to the right of that is today's activity. So you can see what happened. The market ran up. We basically went sideways, a minor pullback, but remained above the 150 period moving averages, and that's all that happened. When you compare that to the intraday 10-minute chart of the spider, it doesn't even remotely look the same. It almost looks like the SPY dove down to get back below the 292 level. Quite interesting. It doesn't look the same. It was certainly a much poorer finish for the SPY than it was the IWM. But I find that interesting. So there's a couple of takeaways from this. Let's look at it both ways, and we'll put both puzzle pieces on the table and go from there. So here's an intraday chart, and we can take this either that this is bullish behavior, meaning the IWM is showing bullish behavior. It had relative strength today against the spiders from an intraday perspective and a closing basis, and we can take that as bullish. Or we can say it was a dead cat bounce. We can go back to the daily chart of the IWM and say, is there anything compelling that tells us that higher prices are coming sooner than later in the IWM? Well, nothing on the daily chart. Now, if we closed above yesterday's high, that may be a different story. We challenged it, but it wasn't able to, and therefore we'll go down to the hourly chart and see what information we have there. And you can see here that when we look at the hourly chart, we see that this has really been in a pretty strong downtrend, pretty heavy grip on the IWM, and this is really just a very paltry bounce in a pretty strong downtrend. Maybe there's some more upside, and we could go up to this 50-period moving average, almost to about 168. We could get there. That's another $1 or so higher, $2 higher. If we saw that happening tomorrow, for example, I would have to think that other markets were positive across the board as well. But we're not so concerned with, or at least I'm not so concerned with the next few hours as I am making the larger directional call. That's really where my mind is. So right now, the IWM is weak. While it certainly could bounce higher, on the daily chart, we could certainly put in a bearish pattern off of, finding a temporary low from yesterday, for example, and then have another leg down. So there's nothing definitive that tells me I want to be long the IWM, and I'm not interested in selling in the hole right now. I was short the IWM. I've since covered the shorts, and I'm happy to reshort the IWM if the chart gives me a good enough reason to. What's the VIX telling us? Well, it's interesting. The VIX is really bearish. The VIX is telling us below all the moving averages, going sideways, not able to get any kind of a rally going whatsoever. The VIX is bearish, so we have to take that at face value. Here's one for the books. Look where the VIX closed today, 1161. Let me point out an important low. Here's an important low. 1159 is the low of that breakup candle right here. So the VIX closed 2 pennies above that price level. Is the VIX going to break below that level, come back down toward this gap, which has already been filled? So if that's the case, the gap really is non-existent. That means we're coming down to double bottom into the low 10 neighborhood once again. That's, in my book, certainly possible if we close below 1159 and have some follow through to the downside. So I'm also watching the VIX very closely. It's another puzzle piece on the table. Very, very interesting. These markets are A, very interesting, and B, admittedly, not easy to read right now. How about the transports? So similar to the IWM, the transports are my second favorite market leading indicator, and we had similar activity in the transports today. They were up along with the IWM, so they're still trading in concert with each other. Remember, yesterday we said either something is going to give with the IWM and the transports being down together and all the other markets being up, the transports and IWM reverse to the upside and everything has another leg higher, or the equity markets reverse lower and everything goes down together. One of those scenarios is extremely likely right now. They're just unlikely to stay disconnected for very long. Again, been to this movie, read this book many times. I know how it ends. How about technology? Looking at the Qs. Again, from a daily chart technical perspective, similar to the spiders, there's nothing wrong with the market. Now, I don't have the same exact type of price level in the Qs that I have that we're calling a pivot that I have in the SPY. I showed you why it was so important in the SPY. We don't have the same look in the Qs. We're really butting up against the old all-time highs. We pierced through it, a spike through by 1 penny, the all-time highs the other day, and here we are below that price level, but it's quite simple. Above the old highs, and we begin closing above the old highs, that would be extremely bullish for the Qs, and if we can't, then it's likely going to reject price in the other direction, come down toward the 20-period moving average for starters. How about the financials? So here's the XBD, and it was quite the day, or the up day, in the XBD today. Up about 1.6% over $4 in the XBD. So again, here we are again with the financials. Remember, without the financials, it's unlikely the market goes anywhere. So my point there is, if we're going to have another strong bull market leg higher that's sustainable, you're going to have participation from the financials. By the same respect, if the market's going to fall out of bed and there's a trap door here somewhere, the financials are also going to fall out of bed. And here we are today with the financials up very, very nicely in terms of the XBD. Also, looking at the XLF, And by the way, they were beaten down, so we have to recognize what we have here from a big picture perspective. They were beaten down, we broke below the former pivot low, and here we are recapturing that level, but not able to close above the 20-period moving average. But keeping in mind what we have in the bigger picture, look, until we get above these moving averages right here, and frankly, until we get above this breakdown candle high, there's nothing doing in the XBD. But it was a nice, impressive one-day bullish move in the XBD. Now, the XLF, we also had a nice big up day in the XLF, but it didn't finish near the highs. It's well off the highs. Remember what we said. So we were looking for support down here around 27.74. Now, the market stayed below that level a couple of days, and what did we stay before? When a market is having a difficult time with a particular price level, it tends to gap above or below that level in order to get past it. Well, guess what? The market gapped above that level today and stayed above that level, at least temporarily. That's bullish. I really think everything hinges on the 292 and the spider, and I find it hard to believe that the XLF would be headed higher if the spider and the S&P 500 are headed lower. So I'm just going to go with the story that all markets ultimately, in a larger move in the bigger scheme of things, they're just going to trade together. That's just the way it works. Here's a chart of the SOX. So the SOX up 0.4% today. It's generally a good representation across the technology sector, but guess what? It's a mess, and let me explain why. We're above all the moving averages, that's bullish. We're below this breakdown candle high, that's bearish, that's here, okay? We've already satisfied, from a symmetrical standpoint, the move down here off of this breakdown candle high, and we continue to make a long-standing bearish pattern in and around these moving averages. It's very hard to read, and here's the only way that I can read the SMH. It's a bearish pattern, however, I'm not willing to be short while we're above the moving averages, and it will turn bullish if we can close above the high of the breakdown candle right here. So that's my story. So close above, that's bullish. But this is a bearish pattern, and I'm going to, at least in a way, I'm going to almost pretend that this doesn't exist. That's kind of what I'm looking at right there. I know it's there, but I'm almost pretending it doesn't exist. And if you take that away, what would we be saying? We would be saying this is a bearish pattern, and this is likely to give way. Once we get below these moving averages, the floodgates to the downside should likely open up. But this is definitely putting a hamper in that. It's a crimp. Now there's nothing doing in gold yet. We had the big up day the other day. This is today's activity. This is the activity from the 3rd. The little green candle you see here underneath the 20 moving average, that's the electronic session that will lead into Thursday's activity. So this really could be making a bullish pattern, but it's way too early to tell. We have no idea. So the only way we have to look at this is we may get interested in a long position at the low of the breakup candle. That's the only thing I would be looking at right now. I'm not looking to short the market to get down there. I'm saying if it did get down there, I might be willing to take a look at it. I'll check back on it in a couple of days, but until we have 3, 4, 5 days of activity that tells us it's putting in a bull flag pattern or some kind of a bullish pattern off of this breakup candle, until we have more activity, there's nothing to do here in the gold market. And when we go over to crude oil, we see here in crude oil, look where we are. We're all the way above $76 a barrel. There's a lot of traders asking, when do we short crude oil? Where do we short crude oil? You short crude oil when the market tells you to short crude oil. Right now, it's in an uptrend, and you don't want to get in front of the bus. Why would you stand on the tracks of a freight train going 80 miles an hour? You wouldn't. You wait for a sign or a signal of a trend change. Where is that going to happen? I would love to tell you it's going to happen at 76.5, or it's going to happen at 78, or some other number. I really don't know exactly where it's going to happen. It may be 78. It may be tomorrow. I really don't know. I'm going to wait for the market to tell me that it's putting in some kind of a top. Maybe it gets up to 80. Why not? it's a big fat round number. We got past 75. There's a chance we can get to 80. If we can get to 80, maybe the top is 81 or 82. We really don't know. Let's let the market ride itself up for a while. And when it does, put in the sign and signal of a trend change. We're obviously going to talk about it when it happens. And here's what I always say. I know everybody wants to catch the bottom or the top, but what I always tell traders is that you don't have to be the first one to the party. You just need to be there to make sure you're there while everybody's having fun. Let me just give you an example of what I'm talking about. And here's why you don't have to be the first one to try and catch a top when you're looking for a short trade like this. So let's say 78's the top, and let's say that you short the market at 78 and it proceeds up to 82, 3, 4, or 5. It feels terrible. You're going to likely cover the trade. You're going to likely lose money, and you're going to also likely be gun shy to get in at the right time, and you probably missed the trade. How many times has that happened? But here's what we can expect. When we can, assuming we can, identify a sign and a signal of a trend change, not necessarily on the weekly chart, we're looking shorter term. First, I'm looking on the hourly chart, then I'm looking on the daily chart. Once we have confirmation that a trend change has taken place, look what we're approaching. So we're running up and we have a pullback. So here, we're up here at 65 and a pullback comes down to 56. Those are big numbers. Here's another one. Up here, we're at 71 and the pullback comes to 61. Okay, here, 73, and the pullback comes to 63, 64. So here, if it's to 78 or 80 or 81, is it going to be a 10 or 12 or $11 pullback? Maybe, most likely, that's what I'm looking for. So I don't have to catch the first dollar or two. I'm looking for the meat on the bone. I'll try and catch it as high as possible, but I don't know that I will. The market gives you what the market gives you, and you just can't get upset about it. You get what you get and you don't get upset. I know this video is getting a little long in the tooth, but I also know that there's a lot of traders out there that like when I run through some of the stocks, so I'll do a happy medium. I'll run through them quickly tonight. So here's the outlay. So you have Amazon down $18, and when you look across the board, you had the financials up. That has nothing to do with Amazon, but I'm just saying. So you had the transports up, you had the S&P 500 up 2 points, you had the Dow up 54 points. We know we had the end of the day rollover today, but we still finished up, and at the end of the day, we closed positive, and it's important, right? So the NASDAQ composite finished flat. It was up more, but finished flat. So Amazon had a down day, so it was down another $19. Again, is this a lower high? It sure looks that way. Apple, in a world of its own. Look at this chart. It's breaking out to new highs. Again, you don't want to get in front of this freight train. It will eventually reverse. However, it's not a stock that I am willing to get in front of. I don't want to be short Apple. Facebook had an update today, but you know what? All we did was come back up to retest the 20-period moving average on the daily chart from the underside and then kind of faded away a little bit from there. It's a busted chart. Look at this in comparison to the Qs. It's not even close. Facebook is a busted chart. All right, so lower prices are likely in Facebook. Really wants 150, and that's just for starters. If we get any kind of sell in the market, 150 is just for starters in Facebook. Netflix, same story. Nothing's changed in Netflix. We didn't go anywhere today. Can make a case. This is very similar to the SMH. Above the moving averages, it's okay, it's bullish, probably wants to fill this gap, but I can also make a case this is a bearish wedge pattern, so I'd stay away from it either way, but we didn't go anywhere either way today in Netflix. Google up $3, but again, high, lower high, lower high, below the 50-period moving average. This is not a chart that says it's breaking out to new highs. Don't you think that Google and Netflix and Facebook, Apple is already breaking out, but Amazon and others would be breaking out to new highs if we were going to have another bull leg higher in the market? I think they would be. And I also understand the argument on the other side. Maybe there's just some sector rotation. Money rotates out of technology into some other sectors, then ultimately rotates back to technology, and the market really never goes anywhere. And I get all that. And that's what you get in a market that goes back and forth for a while. A market that is consolidating a market that is trading around a specific number for a while. That's exactly what's going on. Money is rotating. The market is building energy. It's going to make a move. Is it going to be above 292 or is it going to be below 292? That's the $100,000 question. And with that, I'm out of gas and I'm out of wind. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.